Hello everyone and welcome back to Fun with Fitzy. Today's video is on the second part of Chapter 14, Video 2, and we're going to be going through some examples on how to journalize the issuance of shares, common shares, stated value, par value, no par value, and the exchange of shares for things like land or legal services. So I want everyone to open up the Angel. There's a worksheet that goes along with this video so you can just fill in the blanks here and we can work through it. And then that way you'll have some examples in your notes. So the first example here is for a no par value share sold for cash. So Fitzy Incorporated authorized to issue 10,000 no par value common shares. Okay, so that means I was allowed to sell 10,000. My corporation was allowed to sell 10,000 no par value common shares. And they issued 1,000 of these shares for $1 per share on January 12th. So bank, on January 12th, cash is going to go up. And common shares is going to go up $1,000. We sold 1,000 shares for $1. And because these were no par value common shares, we didn't have to have any concern with contributed capital in excess or anything like that. Okay, question for you. What do you do with the remaining 9,000 shares that you didn't sell? Well, the answer is you do nothing. You do nothing until you do sell them. Okay? Now, if the share price rises, Fitzy Incorporated will issue an additional 1,000 shares for $5 on March 18th. So what will that journal entry look like if that in fact is the case that happens? So on March 18th, we made $5 per share this time, so it was 5,000 for the 1,000 shares. And again, it's common shares because these are no par value shares. So everything goes into the common shares account. Now let's look at issuing stated value shares for cash. Now remember, stated value does not indicate market value. Okay, so we sell it for whatever price we sell it for. However, that stated value has to go into that contributed into the common share account, and anything over that stated value goes into the contributed capital in excess of stated value account. So let's look at this company. Singh Incorporated is authorized to issue 10,000 $1 stated value common shares. Okay, so that's how much authorized means how much are they allowed to sell? Well, they actually sold 1,000 of these shares on January 12th at their stated value. So they sold 1,000 shares at $1. So the entire amount goes into common shares because they sold them for their stated value, nothing in excess. So that's the journal entry. Now, let's see what happens when they sell it above their stated value. So again, Singh Incorporated issues an additional 1,000 of the $1 stated value common shares for $5. So they're selling 1,000 shares for $5. However, they are $1 stated shares, which means the $1 goes into common shares. So how much cash did we raise? Well, we sold 1,000 shares for $5. So now let me flip to my second page here. So there's cash is debited for 5,000. Common shares is credited for 1,000 because that's the stated value. We sold 1,000 shares for $1 stated value. So the $1 has to go in common shares. And the $4 that was in excess of the stated value goes in contributed capital in excess. Note to yourself, the contributed capital is $6,000. The legal capital is $2,000. And that's if you add the two journal entries we just did together. The common shares in the first one was 1,000 and the second one was 1,000. So that's how we get the legal capital of 2,000. And so far the total contributed capital is the 5,000 plus the 1,000 in the first one. Okay, just a note for yourself. Issuing par value shares for cash is similar to the stated value example. So I'm not going to go through them again. The only difference it really is in this word here, stated value changes. It would be contributed capital in excess of par value. So otherwise it is exactly the same. Now let's look at an example of issuing shares for services or non-cash assets. So we know that cost is the cash equivalent price and fair market value of the consideration given up, or if it can't be determined, fair market value of the consideration received is what we should go with. Okay, so again, consideration is what we trade. Usually we trade money. So we have to go with the fair market value of the consideration that we give up. So if we're selling shares, what is the fair market value of those shares? So if we're selling 1,000 shares and they're $10 each, well, it would be $10,000 would be our consideration given up. However, if there is no fair market value of the shares because we haven't sold any yet, we would have to go with the fair market value of the consideration we're receiving. How much is the land worth that we're receiving, or how much is the legal services worth that we're getting? So let's look at a couple of examples. PATA Incorporated is going to issue 4,000 no par value common shares in payment of their legal fees bill of $5,000 on September 18th. There is no established market price for the shares, so we must use the fair market value of the consideration received. Okay, so we have to go with the $5,000. That's the consideration received. So our journal entry here, we didn't get cash, but our legal fees expenses are what we're getting basically. So $5,000 there, and the common shares goes up by $5,000. Basically, it's kind of like we're selling common shares for cash, only we're not getting the cash. They're giving us legal services. Let's look at this one. Schaefer Research Incorporated is a publicly held corporation. Its no par value shares are currently traded at $8. The company issues 10,000 shares on October 1st to acquire land recently advertised for sale at $90,000. Okay, so let's think about this one. We're going to give up shares that are fair market value is $8, and we're going to give 10,000 of them. So that would be $80,000 of the consideration we're giving up. However, the consideration we're receiving for the land is $90,000. So the question is, do we go with the $80,000 or the $90,000? Well, we're going to go with the consideration given up. So there we have the $80,000. We're giving up our shares at $8. So our land is debited for the $80,000 because we just got land for the issuing of our common shares. All right, so that's everything. So for the end of today, you should be able to journalize all of these types of share issuances, and hope this video helped, and we'll talk to you soon.